The biggest reason for failure in the world of trading is a trader's constant desire to predict the market direction, without actually understanding whether the market sentiment is truly bullish or bearish. To solve this common problem, I developed a unique proprietary indicator based on the deep study of various technical strategies and extensive academic research. I'm David. In this video, you'll only see my AI avatar, but I want to assure you that everything you see regarding trading will be 100% real. Let's take a look at where we started in building this indicator. If you've ever tried trading yourself, you'll have realized that the main challenge is truly understanding the complex direction of the market in order to anticipate it. The truth is that absolutely no one can accurately anticipate the market, not even the very large operators. So, what is the correct strategy? Well, right here we can discuss the core underlying distinction between the institutional approach and the standard retail approach. The typical retailer has absolutely no clear understanding of what the session bias actually is and simply interprets it based on their own personal feelings. It seems to be long, it's pushing, it seems to be short. The bias is the momentum. For traders, these are always very intricate and complex topics because trading activity depends heavily on a thorough understanding of them. What is the market regime of that specific one? The trading session, particularly when it comes to intraday trading strategies. But in reality, for any type of trading, whether it's swing, position trading, intraday or scalping, understanding exactly what the current market regime is, the specific strength with which the market is pushing in a direction is of vital importance for your overall success. The main issue, therefore, is that for the retail trader, everything is subjective, it can't be replicated every day, and for this very reason, it can't be tested. This is where the real gap between institutional and retail lies. Absolutely no one at the retail level manages to turn the reading of the bias into data. There is a significant deficiency of available tools, and there is currently no research aimed at discovering and identifying a possible solution. The purpose of this video and of this channel in general is precisely to educate you to reduce this gap between institutional and retail traders. And everything I will tell you from now on is the result of years of research and studies that I have conducted throughout my career. As a professional trader, I have always asked myself this important question: how can I automate the reading of market bias? Because it is truly one of the most complicated topics when it comes to intraday trading, since it depends on so many different factors. Is it possible to build a tool that performs calculations so precise that it can tell me what is the actual underlying directionality of the market? And what if I told you that you could utilize a sophisticated technical tool that tells you not only the directionality, but also exactly how much momentum and strength it possesses? On a percentage level, is the specific market bias actively present on that particular day? Well, this is the primary purpose of my extensive research, and this is the fundamental reason behind building my own proprietary indicator, which I call the bias tracker. Now, let's take a much closer look at the main essential conditions that are absolutely necessary for everything to be perfectly aligned. The methodology I used is very simple, logical, and systematic. It is a highly institutional approach built on many decades of rigorous validations, extensive academic research, and proven strategic frameworks. So I went to study and identify what are the very best edges in the market, both in terms of academic research and in terms of tested strategies. And not just tested by me, that's not all, but also tested at the institutional level. So I studied for years auction market theory, the theory of auction markets, the strategic logic of the opening range, which is one of my favorite edges, the concept of the gap fill, meaning the closing of the gap compared to the previous session. And I also included the VWAP, which is defined by many detailed academic studies, like this one here that I'm showing you on the screen, often called the holy grail of day trading. You can easily search for the title of this study online. This is an institutional research paper that is now completely accessible to everyone. It explains in great detail the substantial advantages of using the VWAP, or volume weighted average price, within your own intraday trading strategies. To help you get started with these concepts, I will begin by providing a helpful and brief introduction to exactly what the VWAP is and how it works. Let me know in the comments if you want a more in-depth video about this indicator. The VWAP is a technical analysis tool that is displayed using distinct upper and lower bands. So these lines that are drawn on the chart essentially indicate the calculated fair value for the day, and it tells us exactly what the most accurate and appropriate prices for that specific day. This is based on the traded volumes that all market participants, and particularly focusing on the larger ones, are willing to pay. And the price, of course, is found right on the central line, which on my chart is always highlighted in orange, just as a matter of my own personal preference. This tool essentially tells us that this price level is universally accepted by the market, so it's very easy for traders to transact at this level. When the price reaches the upper standard deviation prices, it has a strong tendency to return toward equilibrium. The same applies to when it reaches the lower standard deviation edge, where it will rebound and move back upward to seek equilibrium. There are a wide variety of strategies based on VW Apeto, which are specifically and carefully built on the logic of mean reversion, that is, selling at the upper standard deviations, and there can also be even higher standard deviations, buying at the lowest standard deviations. So this incredible tool, and this is directed at every single one of you traders who trade with demand and supply and don't use it, well, you really need to start incorporating VWAP into your strategy, because for those who trade with demand and supply, it gives you very important information about what are premium supply zones and what are discount demand zones. It is quite obvious that this is exactly where trades have a much higher percentage chance of a reversal. This is a useful little technique for those of you who don't currently use VWAP. However, based on our extensive research and detailed study, this tool takes on a completely different form, namely my own proprietary indicator. This specific calculation only takes into account the fair value, which is the actual volume-weighted average price, and it clearly identifies the directionality, whether the price is moving above or below that specific level. In terms of overall market bias, we see when the price trades above the central bar, we are currently in a bullish momentum phase. Conversely, when we trade below, we are entering a bearish momentum phase. So this is just one of the several important technical parameters I use together to accurately read and interpret the market bias. The second major category of research study specifically focuses on opening range breakout and trading strategies. Right now, these strategies are increasingly popular and widely utilized throughout the retail trading community. But as you can see, they have already been used, tested, and back-tested by institutional traders as well. This is another paper that you can find for free online, which discusses an opening range strategy. A 5-minute breakout on the particular, the top 20 most important stocks at that time. I won't go into detail about this strategy here because you can find this paper yourself simply by searching for the specific title on Google. It's a truly fascinating and highly effective strategy. The opening range breakout is essentially based on this logic, a breakout of the first 5 minutes, the first 15 minutes of the cash session. So here we're talking about the New York opening, 30 minutes, and there are even those who trade the breakout of the full 60-minute range. But right now, we're not mainly interested in the specific breakout logic, but what matters most to us is knowing that in order to properly assess the bias of a session of the market, it's absolutely essential to have multiple time frames for comparison. When you observe breakouts on the 5-minute, 15-minute and 30-minute time frames, it is a critical signal. This is because if the price keeps pushing higher and continues to break through the established highs of the previous periods, it represents a very strong bullish signal, especially when combined with the VWAP. Even just analyzing this behavior could offer you some incredibly interesting and valuable information. It is important to clarify one thing: all these factors, if considered individually, do not provide the same level of edge. To have the full advantage, you need to combine all these factors together, including your specific opening range trading strategies. In this case, I am not going to take the trade. I'm not talking about applying the opening range strategy. I'm merely referring to the process of monitoring to actually see the overall directionality of the market, the breakouts that have occurred in a session, and then my absolute favorite, the auction market theory. I would like to share a few thoughts about the auction market theory. Let me know in the comments section if you want to dive deeper into the auction market theory further, because it is the foundational study from which all other studies are based. All other order flow studies essentially originate from it, so it is really very important. The auction market theory, to put it simply, says that the market can exist in different phases, such as a balanced market phase, but then it inevitably seeks a new balance in higher or lower zones. Consequently, we then have an unbalanced market. When we are in a balanced market phase, there is no... Let's look at the bias. So I use the volume profile to see the letter shape that the profile forms. If the profile has a clear D-shaped bell curve form, it indicates there is no bias. However, when the profile develops a P shape, in this case a P shape means that the bias is bullish. Why is that? Why does it move from this value area to this new value area? Following this clear market imbalance, participants are now willing to accept and pay a significantly higher price up in this area. This clearly indicates a notable shift in sentiment where they are willing to pay more for the same asset, just as in the earlier case where they were eager to sell their holdings at much lower price levels. And here, a B-shaped market forms. Having a deep understanding of this critical market information allows us not only to apply it to many diverse trading strategies, including, among others, the opening range breakout strategy, but it also gives us clear and consistent day-by-day information about where market participants are willing to execute their trades. So a little trick: if you set the volume profile only on the New York session day after day, you will see if we are in a trending phase, the value area, meaning the brighter area, will keep moving higher and higher, just like in this case where we were always trading at higher prices. This is a bias-related piece of information that, combined with all the others, gives me a very precise insight for building my indicator. Obviously, there are also get-fill strategies, so let's assume that this right here is the close of the previous trading session. Now, closing this gap gives me some key information suggesting that the price should continue to push much higher. Alright then, these are all the key parameters I take into consideration when carefully reading the bias. Now, the obvious question that follows is, how do I accurately calculate all of them together? Because there are so many parameters that it's difficult to evaluate them. It is crucial for you to understand that each parameter has its own unique and specific weight. What I have successfully achieved here is a highly precise output, which is essentially a percentage that represents the strength of the bias. My rule is to trade only and exclusively in favor of the bias, also because that's mainly what I trade. ES, meaning the S&P 500 future, which is a directional asset. I validate and analyze it in the pre-market session, and it serves as a crucial context filter, so it works specifically to give me the necessary background information. It is not an autonomous signal that just blindly tells you whether to buy or sell, so please be very careful. This is extremely important to understand, but it specifies for me exactly what kind of market regime we are currently in. On my chart, it will be displayed. It is displayed in this way. I have a bias score. This screenshot is taken directly from my platform. In this case, on the day I chose as an example, the bias had a bullish strength of 50%, which according to these parameters is very high. Below the price chart, I have this chart here that tells me the level of the bias, where we have minus 100% and plus 100% as the extremes. The key levels are for weak bias, which is between minus 15% and 15%. So here, for me, it's no bias. When we are above 35%, it's a strong bias. And when we are below minus 35%, it's also a strong bias. Obviously, here it will be long bias and here it will be short bias. So for those who work with breakout strategies, for those who wait for directionality, for momentum, well, this highly sophisticated tool tells us exactly when all the essential market parameters are present to consider a bullish day, whether we are dealing with strong bullish momentum or even with significant bearish momentum. If you want to see this system in action for yourself, make sure to subscribe to the channel and keep following me very closely, because in the very next videos I am going to provide you with detailed walkthroughs of the bias tracker in action across various live market scenarios in real time.